I'm Ray Vars, a portfolio specialist and partner at Harding Loevner. I appreciate the opportunity to speak to you about the Harding Loevner global equity portfolio amidst a difficult environment. Supply chain disruptions and growing demand in the wake of COVID last year already had investors fearful of inflation and higher interest rates, which was weighing on markets prior to Russia's appalling invasion of Ukraine, which only added further fuel to those concerns of inflation potentially not only being higher, but lasting longer as energy and commodity prices have only raced higher. In the midst of that, global markets have fallen this year through February. The All-Country World Index has fallen 7%. And our portfolio has fallen even further, down 13% in US dollar terms, really as a result of style headwinds and stock picking. Our approach is to identify high quality, growing businesses and invest in them with a long-term perspective. And that's led to good performance. When you look at rolling 5-year periods, the portfolio has outperformed about 80% of the time since its inception in 1989. During that longer period of time, the fundamentals of the business are able to translate into strong portfolio performance. But over shorter periods with sharp corrections, the global portfolio has actually underperformed frequently, including this year to date. We've broken down the performance of the MSCI All-Country World Index year to date through February across the 3 metrics we care about: growth, quality, and value. And when you look at the fastest growing quintile of companies, it's underperformed the slowest growing quintile by about 1,200 basis points in the first 2 months of this year. Value, there's been an even bigger gap, with the cheapest stocks outperforming the most expensive by 1,800. Perhaps more surprising, quality hasn't provided much of a defense, with the highest quality cohort underperforming the lowest quality cohort by nearly 1,000 basis points. In that environment, that style has been a headwind, and we can see it in an attribution. As opposed to attributing performance by the typical region or sector, what we've done here is done an attribution across those value ranks we highlighted before. What you can see is our skewness to more expensive stocks, willingness to pay up for high quality growing businesses, has cost the portfolio about 300 basis points year to date. And to the right, you can see stock selection has cost just about as much. So it's about a 50-50 sort of breakdown between style headwinds and stock picking on what's hit performance this year. Looking through to the companies, which is what we do, what we care about. We don't try to time style cycles. We don't try to make macro prognostications, but we try to focus on businesses. And in times like these, the businesses that underperform, the stocks that underperform, we want to look at again and try to understand, is there a change in the business that compromises the investment thesis? Or is the stock just down, the business is still strong, and it's an opportunity to stick with or even add to the position? What you can see in the bottom 5 performers is that they tend to be across healthcare and tech-related sectors, areas that we've found rich opportunities historically that have done well, but those have hurt the portfolio this year. Of those names, let me go through a few of them. Abcam, that was our only exposure prior to the invasion to the Eastern European region. It's an IT services business, but about 60% of its engineers are based in the Ukraine, Belarus, and Russia. As tensions rose prior to the invasion, we actually sold the stock from the portfolio. The remaining 4, we think, are all strong businesses. Sismex, to be fair, is a bit of an expensive stock coming into this, which no doubt hurt performance, but it's a niche medical testing business that we think has great potential going forward. It's actually a leader in blood testing, which requires consumables to go along with the equipment. And so it's sort of a razor blade model, where about 70% of its revenues come from those consumables that need to be used every time a test is made. Abcam is another niche medical related business. They actually make high quality antibodies that are used in medical research. Again, a growing area and a place that we think we would like to keep clients' capital. Meta is a bit more controversial. There's certainly some skepticism as the business model is a bit in transition and it's seeing more competition. But in the end, it's a free cash flow beast that's investing in innovative new product that we think will help fend off competition and lead to longer term growth. Most controversial perhaps is WuXi Biologics. It's a very strong franchise, but it's been weak for two reasons recently. One, it was an expensive stock coming into the year, and like many expensive stocks, it's down. But two, it's been caught up in geopolitical tensions between the US and China. We think that that's not going to have a long-term impact on the business itself. And in the meantime, the business is performing very strongly. And in fact, it just reported earnings last night. It doubled its earnings year over year, and it strengthened its pipeline by about 20% year over year. Stepping back and looking at China more broadly, it's been an area and a market that's been very weak over the last year and a half. Nonetheless, we think it's a rich opportunity set for businesses. In addition to WuXi Biologics, we own 6 other businesses across a number of sectors where we see strong growth opportunities. We don't think we're out of the regulatory woods in China, so eyes wide open, but we think we're past the peak, and we don't think future changes will be as surprising. It's worth noting that while the rest of the world is worried about inflation and central banks are raising rates, China is actually easing its monetary policy to support the country and the economy. So we don't think we can time cycles. We don't know when value or growth will outperform. Instead, we focus on businesses. In times of dislocation, we stop, we inspect the businesses, we take a long-term perspective. We're not going to chase commodity stocks just because prices are up. Instead, we're going to look for high-quality businesses, companies that are driven by innovation or strong consumer engagement that allows them pricing power or the ability to grow even in challenging environments. So while performance has been weak currently, we see it as an opportunity, again, take a long-term perspective and take advantage of the dislocation to invest in these high-quality growing businesses, which we continue to find across the world.